Welcome to This Week in Impact, where we bring you three of the most interesting impact investing and sustainable finance stories of the week, as covered by ImpactAlpha. I'm Brian Walsh. It's Thursday, September 19th. I'm joined today by ImpactAlpha's editor, David Bank. We'll discuss lessons from blended finance in leveraging catalytic capital at scale, new efforts to drive the ownership economy, and we'll preview how to find the alpha at New York City's Climate Week. That's all coming up on This Week in Impact. Hi, David. You just got back from Denver on a reporting trip. How was that?
Well, it's always great to get out and meet folks and agents of impact in motion all around the country. So I'm charged up.
Great, and we'll get to the topic of that conference you were at in our second segment. But first up, earlier this week, we hosted one of our Agents of Impact calls, where we looked at practical lessons in blending billions for things like renewable energy, sustainable agriculture, health, education, small business lending, you name it. David, so-called blended finance or catalytic capital has been a promising idea for many years now, but until fairly recently, it hadn't seemed to reach large-scale, big-dollar deals. How is that changing? And is this finally an idea whose time has come?
Yeah, Brian, it is one of these things that we've been calling for and predicting for many years. In 2023, there was a big uptick, and it was driven by these deals, some of them indeed with Bs for billions in front of them. And what's I think new is a kind of appreciation, in particular by institutional investors, of the possibilities of bringing institutional quality deals to their own investment committees and being able to get them through because with these kind of tranches of junior loss capital or guarantees or first loss reserves that they can meet the risk and return expectations of these big insurers, pension funds, that sort of thing. And so and also I think just the scale of them allow those big investors to come in. So there's kind of one of these things that you keep waiting, and you don't want to miss it when it actually has arrived now. Here's Nnamdi Ibakwe from Convergence, which collects up the data on these kind of things.
It's rebounded strongly. So we've reached a 5-year high of 15 billion in deal volume. So big picture, things are certainly moving in the right direction. 2023 saw a surge in deals over 100 million. Typically, those deals represent around 20-25% of our deal volume, and we saw it reach 40%. The cadence of deals increased, whereby you see more deals on average per year. And climate blended finance space saw volumes more than double in 2023. So the market is definitely growing. But arguably, I think we're in the midst of a very punctuated moment where we're going towards scale, where we actually see the needle moving when we think about these larger deals. And as this forum is aptly called blending billions, I think we are in the midst of just exactly that.
All right, so it sounds like it's promising that things are growing in the blended finance space, but how do these deals actually come together?
Well, the SDG Loan Fund is one of the biggest to date and sort of the template in a way for these kinds of things. And it is a blend of about $1 billion from institutional investors, including Allianz, the big German insurance company. And then there was a development finance institution, a so-called DFI, FMO out of the Netherlands. And then there was also a small guarantee from the MacArthur Foundation. And Deborah Schwartz of the MacArthur Foundation joined us on the call, and let's let her explain it.
The SDG Loan Fund is part of our catalytic capital portfolio. And it is a $1.1 billion vehicle. To a point that Dennis made, the leaders in creating it are Allianz Global Investors, institutional grade asset manager, and FMO Investment Management, which is the investment asset management arm of a leading development bank in the Netherlands. So the two of them created the idea for this. And what we've ended up with is a structure where we have multiple institutional investors, insurance companies and pension funds, supported by a first loss investment from the development bank, supported by a guarantee from a private foundation.
So that was an SDG loan fund. What about blended finance deals in the climate space?
Well, it's important to note that these are not just kind of plain vanilla deals of any sort, and they're not even just plain vanilla impact deals or climate deals. A utility scale solar field now can get financing from any number of places, including quite traditional financial institutions or institutional investors. So the blended deals really push the boundaries, whether it's climate adaptation versus just mitigation in the form of renewable energy, or for example, a real focus on low-income countries that might be perceived as having a higher risk profile. Climate Fund Managers, for example, has done a very innovative debt for nature swap with Ecuador for the preservation of the Galapagos Islands. They've raised more than $850 million already, and they're not done yet for what they're calling Climate Investor 2. And here's Climate Fund Managers Rajashri Padmanamdi.
The way we have structured them is that there's public capital that comes in either as donors or grant or as first loss capital. And then there is mezzanine equity and senior equity that comes as from private investors. So I don't want to put in big words there, but basically just concessional low return capital from public investors and a little more profit-oriented investment from commercial investors.
So these deals bring together different types of investors that have different priorities. Where does this go from here?
Well, one of the big questions that came up on the call and in general is, these are subsidies essentially, right? Commercial investors who aren't willing to get into these kinds of sectors or kinds of financial arrangements, on their own, perceived risk or scale, as I said, or different factors that make them not institutional grade, and so the taxpayers or the philanthropic folks are expected to kind of come up with risk reduction measures to make them more palatable. And the question is, well, why should the taxpayers or the philanthropies, be subsidizing private capital? And Ariana Pavidi of Mitsubishi UFJ had a pretty good answer, I thought.
I always joke that blended finance is meant to be the little wheel on the bike when you're learning how to ride a bike, and it's supposed to fall away and that you can then do it on your own. And I think that in our case, more than just the jurisdictions that Gaia is targeting, it's the concept of long-term lending into climate adaptation, working with sub-sovereigns, things that just mainstream commercial banks are not used to.
All right, that sounds super interesting. A lot going on in the blended finance space. Sounds like a really interesting call. We'll have a full replay available on ImpactAlpha.com with a link in our show notes. But let's take a quick break. When we come back, we'll look at new developments in moving towards an ownership economy. David, an interesting beat that we've been covering here has been the ownership economy. And you just got back, as we mentioned earlier, from a reporting trip in Denver talking all about that. Tell us what you learned in Denver.
Well, it seems the ownership economy has arrived, and this grouping in Denver was sort of a kickoff or a kind of present at the creation moment, bringing together folks in home ownership, employee ownership, tenant equity building, community ownership, and even financial assets like retirement accounts and things. And the notion is that ownership of assets is really the key to wealth building and particularly to overcoming racial and other wealth gaps, and that wages and income alone won't do it. There's been a kind of interesting moment in the last few years, kind of post-pandemic, where between home values and the strong labor market and some of the cash assistance that came through in some of the relief legislation, that wealth at the bottom has grown for the first time in decades, but it's kind of just maddeningly slow. And to really accelerate that, you got to give people a stake in the kind of assets that appreciate. And so what this gathering in Denver brought together was a whole wealth of strategies for doing that and for sort of turning the tables. I think there's kind of a notion that like first you'll bring people up out of poverty, and then you'll kind of get them a living wage, and then eventually they'll maybe save a bit and get a retirement account, and eventually maybe be able to buy a home. And it kind of is sequential in that way. And I think think what I learned there, the biggest takeaway for me was, no, you might want to flip that on the head and get people some assets that are going to appreciate at the front end, and let that help them build wealth, and better income in a sense comes out of, or better livelihoods come out of that. So really changed my thinking in a lot of ways about how to think about sort of income inequality and wealth inequality.
So, David, I'm old enough to remember the George W. Bush administration when they had proposed something along the lines of an ownership economy, but that was an ownership economy more focused on privatizing things like Social Security so that people would have these retirement accounts and have access to the stock market. But this is a different take on ownership. It's not just the passive owner of stocks in the stock market, but it's more about active ownership of the company you work for, or the home you live in, or the community that you are a part of.
Well, I think you're right, Brian, in that there is a kind of bipartisan or post-partisan appeal to this, in the sense of giving folks a stake in assets that appreciate it can be both conservative and liberal at the same time. And so there is a moment now where different strands of the population and different strands of the political world can come together around this. Leaving aside privatization of Social Security, the stock market has been a big wealth generator, but again, not the only one. Like you say, like home ownership is obviously important, not just as a financial asset, but also as a security and just a place to be and place to raise your family. So that has a lot of appeal, and there's lots of initiatives around first-time home buyer assistance and even preserving people in homes. I mean, one of the most interesting outfits that I learned about this week was something called Rock USA, and they've got a spinoff called Integrity Community Solutions, and there's been a big issue of private equity firms buying up mobile home parks, and then folks who actually may own their homes but don't have the land that these mobile homes are sitting on, getting displaced, or at least getting priced out. And so there's notions of co-op or community ownership of mobile home parks. So there's lots of innovation going on that can give people both a higher level of economic security, and then also a leg up or a stake in growing assets.
And what's next for the ownership economy, and what more are we going to hear from this beat? Employee
ownership really seems to be the thing that has caught people's attention in the last couple years, and there's what folks refer to as the silver tsunami of aging baby boomers. Many business owners who are aging out and may not have kids that want to take over the family business. They have a relatively limited set of choices. Sometimes they can sell to a competitor, they can sell out to private equity, which might respond with job cuts and layoffs, or they can sell to their employees who have been helping them build the business all these years. And there's been a number of obstacles for that to happen. The main one being that the loan through which the employees might buy the business often has to be borne by the seller, him or herself. And that's often the same money as the retirement money that they might have been eager to take and move to the beach or the golf course. And so a whole raft of funds are coming in now to finance employee transitions. There's things like ESOPs, which people may have heard about, employee stock ownership plans, have tremendous tax benefits. And so being able to finance those kinds of transitions, there's other mechanisms as well, employee ownership trusts and co-ops. And so the notion that the employees can now own the business is becoming quite appealing and even investable.
All right, well, transitioning from owning the business to owning the climate and climate solutions, let's take a quick break. And when we come back, we'll preview New York City Climate Week, which starts in a few days alongside the UN General Assembly. All right, David, as our colleague Amy Cortese has previewed for us, Climate Week is coming up next week in New York. What are you most looking forward to?
Well, I'll be there. As you said, it used to be sort of alongside the UN General Assembly. All these global leaders were in town in New York anyway, and so let's highlight climate. Now it's kind of maybe overtaken it, and people go to New York for Climate Week, and who cares really about the General Assembly? But so there's something like 600 events all around town. It's a little overwhelming. You've got to get yourself from here to there and run all over town. We're going to do a number of events. We're hosting something on Tuesday around climate and gender with some investors at UBS, talking about the advantages that come in climate investing for adding a gender lens, women as customers and beneficiaries, women as entrepreneurs, women as asset managers, and sort of women are essentially key to sort of every climate solution. There's also obviously a whole raft of climate tech and climate startups. Elemental Impact, as they're now called, people may have known them as Elemental Accelerator, just announced that they've gotten a $100 million commitment from the Coalition for Green Capital, which itself got a bunch of money through the Greenhouse Gas Reduction Fund, which was part of the Inflation Reduction Act. So that money is starting to flow, and people are starting to get excited about it. And they're all about helping climate startups kind of get over what they call the valley of death between the kind of their first pilot project and reaching their first customers and then full-scale commercial deployment. So they're kind of providing the financing for folks to move up the scale of deployment. Second Muse is hosting a day-long event, which I'm planning to attend. They've done a very interesting sort of ecosystem around hardware, green hardware manufacturing, and revitalizing New York's kind of small-scale manufacturing, which has been going on there for hundreds of years, and turning that all to kind of all the things that are needed for this green transition, electric motors and batteries and things. And there's just dozens and dozens of things that we can't get to all of them, but we're going to try.
Now, David, we talk around here a lot about the alpha in impact. What is the alpha in climate as you see it?
People talk about, better, cheaper, faster, and just plain cooler. And some of these climate solutions are just going to be the new product categories of the future. And these climate startups that are on display are kind of the early look at some of them. There's also other aspects of the market like carbon credits. They've had a little bit of a rocky time, but there's lots of innovation again going in. How do you actually monetize, but not just climate benefits in the sense of reduced emissions, but also all the co-benefits from cleaner air or more resilient agriculture, or improved livelihoods, better transportation systems. So there's lots of ways in which the climate agenda is now becoming essentially the development agenda and also kind of the startup agenda. And the level of innovation that's on display at a place like Climate Week really does kind of buoy your spirits. There's lots of doom and gloom, of course, in the climate news these days. And when you go to a place like Climate Week, what you see instead is just a tremendous amount of enthusiasm and innovation coming up, and people just raring to get going. And particularly this year with, as I said, a lot of money flowing through things like the Inflation Reduction Act and the Greenhouse Gas Reduction Fund.
All right, David. Well, I look forward to seeing you in person at Climate Week, and I look forward to our coverage of it in the pages of ImpactAlpha and on our podcast next week. Thank you so much, David.
Hey, thank you, as always, Brian.
And thank you all for listening. If you liked what you heard, please subscribe to this podcast wherever you listen and share it with a friend or colleague. If you want to help us out, leave us a 5-star rating and give us a review. It helps other people discover the show. This Week in Impact is a production of ImpactAlpha and part of the ImpactAlpha podcast network. Smart conversations by and for impact investing professionals. For more exclusive stories about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access. Thanks, as always, to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh. We'll see you next week for more Impact.